Hello, everyone. I'm Ted Oakley, managing partner at Oxbow. And again, my favorite person on the economic scene is Dr. Lacy Hunt. Lacy and I are friends, but he's also a executive vice president and chief economist at Hoisington Investment Management. And Lacy, I will say to you that you're the best in the business. That's the only way I can start it out.
Too kind. You're such a good friend. Everybody should know you're biased.
Well, I am, but I know how much you know. I mean, gosh, your level of knowledge is just incredible. But I want to start it out today by two things. One, the first thing would be how you see the U.S. economy, and then secondly, how you see the world economy.
Well, the situation is very similar. The fundamental conditions for future growth are horrible everywhere you look in all the major economies of the world. In the United States, we have two major problems, one with fiscal policy and then another one with monetary policy. The world has similar problems. And uh, I'm a great believer that demographics is destiny, and the United States demographics are poor, and the rest of the world is worse. But on the monetary side, if you look at what's happening to the money supply in real terms and detrended, which I think is very important, we're seeing a major contraction over the last 4 years. And since 1950, whenever that has happened, we've had recessions in 9 of the 10 cases. Monetary policy is very important, and it gets lost because it works so slowly. But ultimately, it delivers a very heavy impact. And inflation, in the final analysis, is too much money chasing too few goods, and disinflation is too little money and too many goods. And we're headed into serious disinflation with some parts of the world in deflation. The second problem, and it's really having a chronic impact, has been for a long time, is that the United States is now has negative net national saving, and this is something we really only experienced during the Great Depression and then momentarily during the Great Financial Crisis. But what that means is that the sum of all private saving, which is household and corporate, plus foreign saving, which is significant plus, and then the government dissaving, we have negative saving. And
And Lacy, let me ask you for the people out there that could I say, or would you say that that's the government spending more money than we're saving, roughly?
that's we are, and including what the foreigners are contributing. And so the government deficit in round numbers, I've used big numbers here, is running 2 trillion, and the private saving and the foreign saving is about 1.85 trillion. So we have negative net national saving of about 165 billion dollars. In fact, the negative saving has increased now for 6 consecutive quarters. And, one of the important concepts in economics is that physical investment, I'm not talking financial, but in bricks and mortar and technology, the things that raise our standard of living, has to have saving out of income. And printing money to try to alleviate that problem will only lead to inflation. It cannot raise the standard of living. The great rationale of Keynesian economics was something called the paradox of thrift. And Keynes said that when people do the right things for themselves and they prepare for the future and allow for contingencies, they save more than is available for spending, and the government should come in and run budget deficits. However, when the total aggregate economy is living beyond its means, then the rationale for deficit spending ends. And unfortunately, both of the major political parties are proposing further increases in deficit spending and even greater level of negative net national saving. Now, those two problems have had a very insidious impact on the U.S. economy. There were two outstanding Swedish economists, both at which taught at Harvard, Berg and Hendrickson, which in a book written in 2000 pointed out that for every a 1% increase in the size of government, you lose about 1/10 of 1% of your real per capita growth. And so we were at 25, we're now at 36. And so over this time period, we've lost a little bit more than 0.1% of our growth rate. So we were 2.3 from 1870 to 1970, and now we're growing at 40% less. And that's a real chronic situation.
Are you saying that the government portion is 36% of GDP?
That is correct.
Yeah, that's amazing.
And every time it goes up 1%, we
Yeah.
lose 1/10 of 1% off of growth. And so the impact in any one year is infinitesimal. We don't feel it. But let me just sort of elaborate. If we had been able to stay on our historic growth trend in just the last 20 years, not talking about what we lost since 1970, if we just stayed on trend in the last 20 years, then the real per capita GDP and GDI would be about 78,000. That's where it would be. We're at 62,000. That's a big difference, especially for our modest and moderate income households. Very chronic situation.
Basically per capita or per person. I mean,
Absolutely.
that's a big number.
It is a big number.
And what's the since I've got you on this subject right here, I know you've spoken a lot about fiscal dominance, and you might explain that for people out there, but I think I could just say that fiscal dominance is when your fiscal spending gets so high that the Fed, Reserve wise, can't do their job because they got to take care of the fiscal side. And would you clarify that a bit for people, what fiscal dominance looks like here?
Well, it's really better illustrated by what happened during the pandemic. We had a perceived national crisis during the pandemic, and immediately after, we borrowed about $7 trillion worth of debt. Massive sum. And the feeling of the Federal Reserve was that the only way for it to be accommodative was to rev up the money supply. And so we had a near historic increase in 2020 and 2021 and early 2022. And sure enough, what happened to the inflation rate? It absolutely exploded. So the Federal Reserve, which was chartered to be independent of fiscal policy, coordinated with them. And then when the inflation rate shoots up, basically nearly everyone in our society, particularly the modest and moderate income households, they lose. And it was it's still a devastating impact on the vast majority of our people. And so the Federal Reserve gave in to expediency, but the inflation was so painful, caused so many dislocations, that they had to reverse themselves. And of course, achieving the reversal was complicated because the deficits remained large. And we have what I call now this huge contra-normal cyclical pattern, that we're in a late stage expansion and we have negative net national saving. That's an intolerable situation. And it was not one that was envisioned by economists in the past, and certainly not by John Maynard Keynes.
That's supposed to be at the bottom of the recession, isn't it?
That's correct. That is correct. Only then, not at the end of the expansion. And so we're starting off with this chronic deficit, and there are only major spending programs and some minor adjustments on the tax side, generally speaking. And so the fiscal situation is going to become a greater and greater drag. In other words, if you don't have positive national saving, you cannot get physical investment. The physical investment constitutes the increase in the capital stock. And you cannot shrink your capital stock and raise the standard of living. It's simple. It's just that simple.
And why do you think, you'd be interested in your answer on this, why do you think with all of supposedly educated people on the Federal Reserve Board and Powell himself, that they would think that they wouldn't have known enough about history to not know that, they call their inflation, it's just here a little bit, it's going to leave. It's not a big deal. And so why do you think they couldn't see that? Supposedly educated people that should know something.
It's hard to read people's minds. But you have to remember that, and this I think is a real serious problem for the structure of our Federal Reserve. The Federal Reserve is the nation's central bank, but it is also the world's most expensive economic research organization. Unfortunately, however, there is only one prevailing viewpoint of any note within the Federal Reserve. They're all neo-Keynesians. The neoclassical view is not represented, the monetarist view, the Austrian view. And so there is one, they've hired the best students out of the best schools, and they're dominated by the Keynesian point of view. And so that, in my opinion, that approach is wrong. And it's going to lead the country down a very, very difficult, it's already happening. It's already happening. And as the standard of living gets weaker, one of the most repugnant problems for me is that it exacerbates the income and wealth divides. And I think that one of the reasons the United States has historically done well is that, generally speaking, we were able to lift all boats, not equally, but we were able to constantly raise the middle portion and allow our households to buy some of the things that make life a lot easier, allow them to buy homes, to buy new cars, and so forth. And right now, the ability of households to buy cars and houses is lower now than it ever has been. And that's a direct outcome of these policies that have been in operation for a long time, and more acutely aggravated by the fact that the Federal Reserve allowed the inflation rate to get totally out of control as a result of the coordinated monetary and fiscal policy response during the pandemic.
And where's Milton Friedman when you need him, right?
So you have some people that fall in the neoclassical school of economics. Not the only one, but the problem is that there are not many of us, and our voices are not going to be heard. And keep in mind, my voice is. I'm doing this interview with you, but as you know, I don't make a living by handing out opinions. I'm in the investment management business. And so any sort of tangential contribution that I can make is going to be extremely minimal.
Well, one of the things I love about you, though, is that you are an economist, but you're one of the few economists that has to be in the trenches managing money. Yeah. That's a little different twist for most of them.
It is. It's a very difficult and humbling field.
So in this, and I'll come back to this on what we're talking about, but then if you switch to the world economy, because we've got a lot of problems there too, but you might, tell us what you think about that as well.
Well, the problem is that the government share of economic activity is greater in Japan than the United States. It's greater in the EU than the United States. It's much greater in China, and it's greater in the United Kingdom. And so we're doing a little bit better because our private sector, in relative terms, is bigger than it is in our major competitors. But if we continue to go down the path that we're going, we're just going to get more and more of the Japanese, European, and Chinese results here. And unfortunately, there's no discussion of these and critical issues on the economics front in this presidential election. And I don't think it's going to leave us any better off than we were.
And you think, are there any of those countries that all have good demographics, or you think most of these countries have and you might explain that, but where we have, birth rate is just not staying up. I mean, where we are on that.
Well, I think that the great French philosopher Auguste Comte was the one who said demographics is destiny. And what he had in mind here is that you're talking about the age, the composition, and the distribution. And the growth rate has been coming down very dramatically in all of these countries. It's actually negative in Japan and China now. And when that happens and your birth rate falls precipitously, ours is not as bad as our competitors, then the average age starts going up. Now, in the United States, we're the youngest of these countries with an average age of 39. But in Europe, the average age is 44. In Japan, it's approaching 50. In China, and the Chinese play a little bit fast and loose with their data, but the private demographers indicate that it's about 42, and every 2 years that go by, the average age is going up a year. The fact of the matter is, what creates a dynamic situation is a young population, and with new households and children, and that requires a lot of expense, and it helps to propel the economy forward. And it also creates a very fertile environment for creative thought. And so the fact of the matter is, we're all getting older, which means that we have less demand, and we have fewer of the elements which have historically sparked great surges in economic activity and improvement in mankind.
Well, and when you say too, in the U.S., where basically Social Security was set up for the younger, depositors to take care of the older takers at the end, but that's upside down too.
It's very much upside down. And one of the things that Milton Friedman said, you mentioned the great economist, Nobel laureate, he said that immigration in the United States has always worked when those coming to the United States were seeking economic opportunity. And because if they're seeking economic opportunity, they're going to pay for themselves. But if the surge in immigration is related to other factors, perhaps the introduction of crime or the smuggling, or if a lot of the motivation for coming here is to take advantage of our Social Security and Medicare and Obamacare, then the huge numbers of illegal immigrants that have come into the country are going to put even substantially greater pressures on our ability to honor the commitments of those who have paid into Social Security and Medicare for multiple generations. Now, I know that there's always the quick answer. Well, we can always have the government print the money, just as we did during the pandemic. But when you resort to that, you immediately get the inflation, and so you may have paid the Social Security and Medicare benefits in dollars, but you then debase the value of your purchasing power, and the majority of people are worse off. They may think that their commitment was honored, but it was not honored in the sense in which it was made.
Well, I keep hearing this argument too, Lacy, about well, we'll just inflate our way out of it. Not so with Social Security; they have COLA. I mean, they're gonna go up all the way with everybody else, and so it's almost like you can't get out of the trap.
Well, one of the most fallacious concepts in economics is that we can always inflate our way out of it, because inflation is the silent thief, and inflation robs from everyone. But Ted, you have a great deal of capability. I'd like to think that we have some too, but the fact of the majority is that, with the exception of maybe 5 to 15% of our population, they cannot protect themselves in inflation. They cannot do it, and so what's happened in the last 4 years is very illustrative. There's a series that I like to follow that reflects the real weekly earnings In other words, inflation-adjusted earnings of all of our full-time salaried and hourly workers. And it's 120 million people. And over the last 4 years, we've declined at a 2% per annum rate, which is for such a long period of time, totally unprecedented. And the impact on those that can least protect themselves is great. And so the notion that somehow you can inflate the way there will be many that will be able to profit immensely from high inflation, but only few will actually be able to get through.
Don't you find it interesting too that, and I would ask you this question, when's the last time that you would have heard, I can't even remember this, but what the last time you would have heard in Washington, either party, okay, spending any time on, hey, we've really got to get this spending under control? I don't recall the last time.
Well, the last major effort was really in the early 1980s. And, Milton Friedman was probably one of the great forces in moving from the fixed exchange rate system to the floating rating system. And after that happened, there was a major unintended consequence. And when the dollar was no longer fixed, that was the last mechanism for controlling bad fiscal policy behavior. And so much of the deterioration came once there was no discipline. Now, Friedman, when he saw this happening, knew that we had to rectify that. And he pushed very, very hard for a constitutional amendment to require a 60% vote of the House and Senate if we're going to run a budget deficit. In other words, there'd have to be a clear national emergency. You cannot pass a deficit in normal times. President Reagan was in the White House. There was actually bipartisan support for this constitutional amendment in the early 1980s. And the resolution passed both the House and the Senate, but it didn't have the 2/3 majority to go on to the states. And that was the last major effort. And the efforts have become more and more feeble. And there's nothing more than minimal lip service to the budget deficit today. And the reason, and I think, is that a lot of people who were concerned about the budget deficit predicted cataclysmic things. But they forgot T.S. Eliot. When T.S. Eliot wrote, "How does the world end? How does the world end?" And he said, not with a bang, but with a whimper. And because these deficits have this slow, insidious effect, it's death by slow asphyxiation. It's not a crisis. The Federal Reserve proved during the pandemic and also during the GFC that they can come in and that they can flood the economy and get the economy papered through a crisis in the financial markets. But what they have not been able to prove is that this type of activity has a lasting benefit for all Americans.
And Lacy, let's go back on this fiscal dominance and how the Fed has to come in and save the day. Let's say we're going into a recession, and I'm not trying to put words in your mouth, but I do think you think we're slowing down. But if that happens,
I don't think there's any doubt about it.
yeah.
I think we're much more vulnerable than is generally recognized.
And then that being the case, they would have to come in again, okay, and do the same thing they did before. Am I correct? I mean, and really get aggressive on the downside and then push more money in.
Well, they may have learned something, and what they will. I think that they will start slowly. In other words, they'll unwind the tightening gradually. But what they're going to learn is that when you have a highly indebted economy, such as we do, with all of the structural rigidities and the poor demographics, domestically and global, and a global economy that is actually leaning on the United States, and we're not in a position to provide the support that we traditionally have. And so what the Federal Reserve is going to learn when they begin easing, that the results are going to be very minimal in the positive direction. And so they will go for a period of time. I don't know whether it'll be a year or less than a year or what have you, in which they will push on the string. The results will not be very effective, and then they will eventually do more. But even if they do that, and we continue to have negative net national saving, the system is not going to perform in the normal fashion. And so really, there's nothing they can do unless they go back to the coordinated monetary and fiscal policy during the pandemic. And we should all know that that type of action, while it can work temporarily, it leaves you with several years of pain in the form of higher inflation. And so basically there are no viable options. Modern monetary theory is a fraudulent concept. We should have learned this from the pandemic, and if we go back to it again, it will provide no more than a transitory benefit with longer term pain.
So do you think that, so they come in and lower rates and we have a move in interest rates down, but the next round of that coming out the other side is where you reinflate even more?
Well, it depends. It depends upon whether the Federal Reserve is going to honor its commitment to both price stability and labor markets. I don't believe that they'll be able to do so. They'll have to make a very painful choice.
But if the government, which looks like either party will do, they don't seem to be really thinking about anything else but spending. So if the government keeps on spending that deficit at that level or even higher, let's say, uh, they're going to have to pay attention to that. Am I right on that?
They could just temporarily paper it over. The problem, it comes back to this one of the most important concepts in economics is the circular flow. In other words, what we spend equals what we earn equals what we produce. So the gross domestic income equals the gross domestic product. And out of that, by algebraic transformation, what we have is that physical investment equals a net saving. And so they can act and they can calm the financial markets, but without to have physical investment, someone has to push back from the dinner table. There have to be actual resources to create physical investment. And without physical investment, you cannot increase the capital stock. You cannot increase the standard. So you can go back to the well, but it will not produce a fundamental solution, only a temporary respite followed by higher inflation.
So question here, and I remember in 1989, 1990, we lost accounts because we refused to own Japan at that time. They were really expensive, as you recall. And the Nikkei average was made a high, in 89, 90, and it took 43, almost 44 years to even get back to where it was. Okay, and Japan went through that whole period. Here's my question to you: Do you think we're becoming another Japan?
We're on the same path. We're all on the same path. And China may be is badly over leveraged as Japan. In fact, one of the things that is tells me that the fears of inflation are way overblown is because what I see evolving in China today is a debt-induced deflationary spiral. That's the concept when you have these extremes between what you're spending and the level of saving that you have. And so China is getting more and more frail. China is 19% of the global economy. We're 23. Japan is only 12. The Chinese role is immense. And one of the things that was of great help to the United States, to Europe, and especially the emerging markets during the great financial crisis is at that point in time, China was very lightly indebted.
And they could
began
sell to us cheaply.
yes, and
They could sell to us real cheap.
But you see, what debt, debt, the impact of debt is best explained by the law of diminishing returns. When you initially increase a factor of production, such as debt capital, initially the GDP rises. And then if you increase debt further, the GDP does not continue to rise, it flattens out. But if you continue to raise the debt, then eventually the GDP turns down. It's a parabolic effect. It's a nonlinear effect. The notion that by taking on larger and larger deficits, and we can ultimately find the solution, falls because of the fundamental concept in economics, the law of diminishing returns. And by the way, there's virtually no way to explain that to the politicians, let alone the general public.
True. And following that same line, if you look at the high percentage of Japanese bond of government that was bought by the Bank of Japan, and I don't call it a hybrid, but it's a very high percentage, was owned effectively by the government, if you want to think about it like that.
Well, the Central Bank of Japan, like the Fed, they're both part of government. They're subsidiaries of the government.
So my question to you is this: Do you think we could ever go down that path where the Federal Reserve owned, 30% of the debt or something like that? I'm 40.
Frankly, it's possible. I hope not.
Me too.
It'll be disastrous for us.
Yeah.
If you look, there was a great paper written a decade or longer ago by Neil Ferguson, the great economic historian. He taught at Harvard, now he's at Stanford. He wrote a book called Empires on the Verge of Chaos. And he looked at four great empires that became extremely over-indebted. The Mesopotamian Empire, the Roman Empire, the Bourbons of France, and the British Empire at the end of World War II. And in the case of the Mesopotamian and the Roman Empire, the indebtedness eventually emaciated the country, and they could not provide a decent standard of living, nor could they maintain the defense system. The Bourbons of France, a more recent example, but data's better. France started a great borrowing spree to finance the French and Indian Wars, which they lost to Britain. It was basically a world war. And then France underwrote the American Revolution. France spent more helping us win our freedom against Britain than we ourselves. There were more French troops at Yorktown than there were American. It was the French fleet that blocked Cornwallis's evacuation. And then after the French victory, French-American victory at Yorktown, there was a great feeling of hubris, and they continued borrowing. And ultimately, what happened? There was economic chaos for the majority of people in France. And so the solution then was to print money. And of course, that exacerbated the problem. And within 10 years of Yorktown, the Bourbons had fallen. At the end of World War II, the British Empire was covered the world. As Winston Churchill said, the sun never sets on the British Empire. But at the end of World War II, Britain was so over indebted that they could not roll their debt over. Now, Britain, they jettisoned their empire. They could no longer provide the military to hold their empire. Britain had to go through 10 years of rationing once World War II ended, all the way from 1945 to 1956. It was a miserable time. But Britain, the country of Great Britain survived, but the empire was gone. And so what we know from these four great examples, as well as from many other smalling cases, that extreme over-indebtedness is the road to ruin. And let me just give you a more contemporary point of view. There was a great paper written in 2011 by the Reinhardts and Ken Rogoff, and it was called Growth in a Time of Debt. And what they pointed out was that when government debt, gross government debt, goes above 90% of GDP for more than 5 years, that you lose 1/3 of your growth against trend. It's really another way of doing what Hendrickson and Berg had done. And so our growth was 2.3% from 1870 to 1970, and now we've lost 40% against trend. It doesn't matter how you look at it. The growth erodes the base. Slow, steady process. And at the very end, when you try to, if you the Mesopotamians and the Romans, they didn't have a banking system to help them. They'd been borrowing from the moneylenders. They tried killing the moneylenders, but then no one would lend to them, and so they couldn't survive. At the end, the Bourbons tried to print their way out, and that was disastrous. The British did it through austerity, and the empire didn't survive, but the country survived. And so the lesson of this high indebtedness road is not a road that will produce a enjoyable or even sustainable situation.
You know, we have a joint friend, Neil Howe, that wrote The Fourth Turning. And it sort of ties in with that right now, if you think about it, because it becomes, he said, you know, your country in a really, which is 10 more years to go, according to him, but your country either it gets taken over from the outside or it implodes from the inside, from this the deterioration that goes on, which is what you're talking about. But that, I think that's what bothers
me. A very similar concept. The world does not end with a bang; it ends with a whimper.
And I think that's what bothers the average person so much now, Lacy, is that the biggest question we get is, so I'm as a person, they all say the same thing. You know, this is very confusing. Really don't know what to do the next 5 or 10 years. How do we, you know, how do we make this, how do we move forward here with investments and decisions we make and that sort of thing? And if you were looking out there for people and trying to say, hey, these are the things you might consider, you know, at least over the next 5 to 10 years, would you have any thoughts on that?
That's not my area of expertise. I'm just a bum. But I worry about those same things because the law of diminishing returns changes the fundamental prospects for economic growth. And you move further and further away from a normal situation that we've all known. And I think that makes it very unpredictable. And when your growth trend starts moving downward, as it is, the fact of the matter is that more and more people get left behind, and that eats away at the social fabric of the country. And once that starts to happen, I don't know what the predictable consequences of that are, but I don't think they can be good.
Well, and it seems like I don't know what you think about this, but it seems like there is this unfortunate link between Wall Street and Washington that's good for all of those people, but it's not good for anybody else in the country. And that seems to be what's happening over the last 10 years. And I think that's what has people bothered a lot.
Well, I think, and they have a right to be, and I'm bothered by it too.
And so I know I know, and I know you can't talk about this from a business standpoint, but Hoisington's in the bond management business, and mainly treasuries, and so and people have had the advantage of getting 5% short term for some time now. But if I hear you correctly, what happens, what you're thinking is they have to gradually lower those rates, then 18, 24 months from now, that's going to be a good bit lower for those people owning that short-term paper.
I think that's absolutely the case. We have to be on alert to the fact that there will be another modern monetary theory response. But I think that for the time being, one of the things, if you look at the national election, probably the best thing for the country is that the situation in and Washington leaves with a split government. And so while both parties have initiatives that they want to do, they don't want to do the same thing. And therefore, uh, perhaps by being forced into inactivity, we have a time to sort of unwind some of these problems. But that is a slow path, given the magnitude that we have to deal with.
I would say this too. You're a great historian. And one of the things that I always find interesting about both of these groups, by the way, that want to talk about, they nixed the U.S. Steel deal. One side, the other side wants a lot of tariffs. They don't know anything about beggar thy neighbor. It's like they've never read anything about what happens when you start playing ball just for yourself and you don't have a free market. Do you have any thoughts on that?
Well, you factor them. Number one, did we make bad trade deals? Yes, we made horrific trade deals. The problem is that the only way to unwind them is through negotiation. Another problem on the other side is that there is a proposal to raise the corporate tax rate to 28.5%. By my calculation, I think that makes us the second highest corporate tax rate in the world. When you raise corporate tax rates, that's an increase in the cost of production. So when costs go up, firms have to raise prices. If the Federal Reserve does not have a conducive growth in the money supply, then they cannot raise prices sufficiently. And because capital is mobile, in this environment, the capital will not stay in the United States. And so you have proposals on both sides that fly directly into the basic understandings of economics. Let me give you another proposal too, and that is that we would resort to price controls to try to control the inflation rate. Well, one of the most important concepts in economics is the law of supply, which says as the price of a good or service goes up, the quantity supplied goes up. But if you force prices down through price controls, you get less production. Well, that means there are less goods and services, which means ultimately that the attempt to reduce prices through wage and price controls results in even higher inflation. And that's been the case in every time that it's been in use. So we're getting solutions. Our solutions are being offered to the American people that are very simplistic on both sides, but neither of which hold any support from economic theory and economic experience.
Well, and some of it's interesting. You remember the win buttons, the whip
Yes,
inflation now?
yes, I do indeed. Indeed. I, I started my career in 1969. That was 55 years ago. And the win button was in 1973, right? Instituted by Gerald Ford, 1954, after he'd replaced Nixon, who resigned, and basically was the brainchild of Alan Greenspan, uh, who later became chairman of the Federal Reserve Board.
Well, and the other thing is, before I went to Wall Street, my first job was with Anderson Clayton Foods, and we had to buy, soybean oil, all kinds of things to put in shortening and margarine, all that sort of thing. And it's interesting, you had to lock it down because you had so much inflation. By the time you got ready to produce, if you didn't really have it into the futures, you were going to kill, you're going to lose money. It's like what we're talking about here. And another thing I want to ask you, because you see this a lot in some of these states, and particularly see it in Europe. And I just read a great article, and I believe it was the Netherlands, where rent controls had gotten so strong that the people just said, I'm not going to rent the house. I'm going to sell it because I can't make any money on it. You've got me in a corner here.
No, rent control, price controls never work because what they do is they set the price below market value. And so in that situation, you have more demand and less supply. So you have a constant, permanent gap between demand and price. And by the way, there is no economist that I have ever seen argue against that concept. It's in every basic textbook in intermediate and advanced economics, as well as all of the micro textbooks. There is simply no way. And moreover, the worst aspect of price controls is that when they're initially imposed, they do kind of work for a short term. Well, the Fed has an inflation-based target, so they see the inflation rate come down. And because the pressure is always to have lower rather than higher rates, they accelerate growth in money supply, and then you get a monetary effect as well as a supply-demand imbalance. And inflation not only rises, it rises faster than it was before you impose the wage and price controls.
Well, Lacy, I need to thank you for being here. I guess if I had to sum it up, maybe after this conversation, that I could sum it up in 2 words for people that are investing, which is be careful.
I think that's wise.
I mean, there's so many interesting, so many things could happen. You know, we have these world situations. I think that's on people's mind today more than any other time. And one of the things we've espoused, I don't know what you think about this, but we've espoused, hey, you need to have a safety valve here. You know, this is not business as usual right now. We're in a different situation than normal. Would you agree with that?
I would indeed. And I'd say one other thing. There was a story told that when Napoleon was interviewing a man for promotion to general, and the chief of staff is going on about how brilliant the man was. He knew tactics, he knew cavalry, he knew artillery, he knew discipline. And Napoleon stopped the chief of staff and said, "Don't tell me how smart he is. Tell me or not whether he's lucky."
Well, you know, in business, there is the degree of that. People won't admit it. I mean, we have so many people that sell a company, and some of them are just lucky,
Yeah.
but they never would admit it. You know,
Hopefully we'll get lucky.
Yeah, maybe we'll get lucky. But listen, really appreciate you coming on today. We always like to talk about these topics because they're very involved, and like you say, the average person certainly in Washington doesn't really understand the details. You know, so
too complex.
Unfortunately,
and the education levels in the country are failing.
Unfortunately, we can't put you up there as head of the economic advisors right now, but if we could, we would.
No, that's not going to happen.
Listen, thanks a bunch.
Thank you,
Lacy, we'll hope to talk to you next year.
Great questions.
All right, see you then.
All right, all the best.
Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.